Hello everyone. We're gonna do this video on a statement of cash flows using the indirect method. And before we get into it, I'm just gonna do a little intro on what the statement is and the different parts of it before we get into the example. The purpose of this statement is to provide information about the sources and uses of cash during an operating cycle of a company or their fiscal year. So basically, it reconciles the cash at the beginning balance sheet date. So for a calendar year, it would be January 1st to the ending balance sheet date, which would be December 31st. The statement has three main sections, and these are operating, investing, and financing in that order. Operating cash flows are cash receipts and disbursements from transactions reporting on the income statement and current assets and current liabilities on the balance sheet. Investing cash flows, these are your cash receipts and disbursements from non-current assets. And your finance cash flows are your cash receipts and disbursements from debt issued by that company. So there are two methods to completing a statement of cash flows: the direct method and the indirect method. In this video, we are going through the indirect method. The only major difference between the two is the operating cash flow section. So below we have the indirect operating cash flow section of how to complete that. So you start with your net income, and then you add non-cash expenses and losses, subtract non-cash income and gains, and then you add increases in operating liabilities and decreases in operating assets, and then subtract decreases in operating liabilities and increases in operating assets to arrive at your operating cash flows for that operating cycle. The steps to prepare that we're going to be using today are: one, change of the value in the account, whether it's a source or use of cash, and what section it belongs in, either the operating, investing, or financing section. So let's jump right into the example. So in this example, we have the current year on the left and the previous year on the right. And this is the balance sheet. So we are trying to find what this 5,400 increase in cash is from, what the root of it is. So using our steps as explained in the intro, we are going to use the first step, which is the change of the value in the account. So we ignore the cash account for our steps because that's what we're trying to explain. And we go right into accounts receivable. In our case, accounts receivable decreased by 7,000 from the previous year. And then we would do this for all the accounts. So going down the list, we have inventory that increased by 2,600, supplies that increased by 2,500, equipment, store equipment that increased. And you notice how this does not have a number. That's because there was no change in the delivery equipment during the fiscal year. Your accumulated depreciation increased, which was your depreciation expense for the year. Your accounts payable decreased. Notes payable decreased, and this is the current portion of notes payable. The long term is noted down here an increase as well of 21,000. We have an increase of 1,000 in interest and a decrease in income tax payable. And our last item is the change in retained earnings, which increased by 980, which is your net income for the current year. So using our steps, we will move on to the sources and uses. So we'll go through a couple of these. So accounts receivable would be a source because our accounts receivable decreased, which is a current asset. So that means we collected money from our customers, thus increasing our cash. Inventory increased. That means we spent money to obtain inventory, thus being a use of cash. The one thing I will highlight here is the accumulated depreciation. You notice how this goes up, and you would say this is a current asset. And you would be right, but it is a contra asset, thus making it a source. Next, we'll go into the third step, which is identifying what section it belongs in. So the current assets belong in operating. PP&E belong in investing. Depreciation in operating. Current liabilities are in operating, except for the note payable. This belongs in financing, even though it shows in the current liabilities section. And then we'll have our net income, which is in the operating section as per our rules. So next we'll go to the statement of cash flows. And I copied over our steps to show where the numbers are coming from. So we take our net income, and then we add in non-cash expenses like depreciation expense. You add in a decrease in accounts receivable. You subtract an increase in inventory, and so on from our sources and uses step. Once you get to the bottom, you will see that this is a sum of all three categories of cash flows, and it shows our change in cash, which is exactly what the balance sheet said. Then you put your beginning of year cash and then your end of year cash. And that's how you complete a simplified statement of cash flows in the indirect method. Thanks for watching my video. Please like, comment, and subscribe to my channel.